Julian Brigden also joining us, co-founder Macro Intelligence 2 this morning. Julian, good to have you with us. What's your sense? Powell really coming out and saying, look, I am struggling with this entire scenario. It is a challenge. He's acknowledging it. And there continues to be dissent amongst the Fed as well. How do you see things panning out?
Well, I think I was last on the program 2 months ago, and we were debating that, I was saying I think the Fed needs to cut, and we're still having that debate. And the Fed is still trying to inch its way forward, not giving any clarity as per your previous speaker was discussing. And I think that this is going to continue this sort of state of purgatory that markets are in. The risk is in this scenario, unless there's a real breakthrough on the trade side, that the economy continues to lose momentum. And as we move into 2020, when the Fed finally realizes that they have to get ahead of this game, that they're almost too late, that they'll have to cut far more than they'll want to, that we'll move into that unfortunate situation of potentially following the ECB and the BOJ down towards zero. I think it's great news. I think that Powell said he's not going to go negative. But I think this is the fundamental problem. The Fed is not getting ahead of the game, right? They are continuing. You can see the internal debate and the disagreements. They're continuing to sort of lag market expectations. And that, to me, is a big problem.
Okay, so clearly you're also feeling, that the Fed could have done more, or at least signaled a clearer trend. I also want to understand on the injection of liquidity that they've done into the money markets as well. What are you reading from that? That's 2 days in a row that we've seen that from the Fed. And how do you see this impacting the markets, both the cut and the injection of liquidity? Currently, of course, markets are not too pleased at all, but going forward.
So, as I said, I think there's a slight disappointment in terms of the rates at this point, and I think that's fair. The liquidity thing, I would be a little careful. I know a number of people have jumped to the inference that this is, some form of QE. To the extent that it is QE, I think it's more comparable with QE1. By that, I mean, QE1 was really aimed at offsetting a negative. It was aimed at reducing the collapse in liquidity caused by the collapse of the private sector banking system here in the United States. QE2 and QE3 were very different. Those were net additions. This one, I think, is aimed at preventing a situation where what we're seeing is, because of the shape of the curve and that the curve is very inverted, there are fewer buyers of what you would call cash and carry buyers of treasuries. The dollar is strong. The central banks are not great buyers of treasuries. And that's leaving the primary dealers to hold very large amounts of treasuries on their books. And since the GFC and since Dodd-Frank, and now with new rules under Basel III, those treasuries are actually quite expensive to hold. Treasuries used to be considered to be as good as cash. You didn't have to put equity up against the holdings. You didn't have to put capital up against the holdings. And now you do. And as a result, as those primary dealer positions build, the banks are forced to make squeeze liquidity elsewhere on the balance sheet. So as we move into the fourth quarter, where we've got a very large amount of issuance, in part because the Treasury is rebuilding cash positions, we were going to face a situation, I think, where we would have seen a real squeeze on bank provision of liquidity to the economy. And so in that sense, I think what the Fed has done is positive. I just wish they'd done it in a more constructive and ongoing basis, because this thing is not going to be ameliorated overnight. This is going to be an ongoing problem.
Julian, just to wind up then, going ahead, there's still a lack of clarity. He's alluded to possibly one more small cut. The fact that there's dissent within the Fed, there's a chance that we could see two more, again, small cuts. What do you feel is an appropriate cut? Market was calling out for even 50 basis points this time. We know what Trump wants. What do you think the markets would like to see?
So I've been saying to my clients since the start of the year that really it doesn't really matter exactly how we get there, but we need to be in a situation where, to keep this cycle going, which Powell has told us is his number one priority, he has to continue to support this equity market. In fact, he has to drive the equity market higher, because otherwise you risk CEOs starting to cut costs and to starting to cut employment. There are already some signs of that happening. We need ideally to keep rates low, to keep the housing market supported, And we really ideally want to weaken the dollar, to be frank. And I think that takes a rate cutting cycle. And by that, I mean 100+ basis points of cuts. So we're halfway there. They're only really talking about maybe another 25. I think we need at least another 50 and possibly more.
All right, clear takeaway there coming in. Julian, thanks so much for joining us this morning with your
Pleasure.
analysis of the Fed's latest move and that disappointment pretty much